Hello, and welcome to Dr. Dan's channel. This is where we slow things down, step back from the headlines, and examine the deeper forces shaping global power, trade, and sovereignty. Today, we are looking at why Kenya paused a nearly $1 billion trade deal with China, not because the deal collapsed, but because of pressure from the United States, and what this moment reveals about Africa's shrinking room for economic independence in a world of great power competition. This is not just a Kenya story. It is a Global South story. And it matters now. In late 2025, Kenya quietly paused final approval of a major trade agreement with China, valued at close to $1 billion. The deal had already been negotiated. Cabinet review was pending. Presidential approval was expected. And then it stopped. Not because Beijing withdrew, not because Kenya rejected the terms, but because Washington intervened. The message from the United States was unambiguous. Move too quickly toward China, and Kenya's future access to U.S. trade programs could be jeopardized. This was not a public threat. It did not come with sanctions. It arrived quietly, through diplomatic channels, trade signals, and strategic reminders. And it worked. Let's be clear about what Kenya was being offered. Under what was described as an early harvest trade arrangement, China agreed to cut tariffs on key Kenyan exports, expand market access for agricultural goods, deepen manufacturing, tourism, and logistics cooperation. Specifically, tariff reductions covered tea, coffee, avocados, fish, selected horticultural exports. For Kenya, this mattered enormously. China is already Kenya's largest trading partner, but the relationship is structurally imbalanced. Kenya imports far more from China than it exports. The deal was designed to narrow that deficit, not eliminate it. In return, China would gain greater access to raw materials such as titanium, ore, expanded commercial presence in East Africa, deeper integration into Kenyan infrastructure and supply chains. From Beijing's perspective, this was not unusual. From Nairobi's perspective, it was pragmatic. The pressure did not emerge in a vacuum. For 25 years, Kenya benefited from the African Growth and Opportunity Act, a U.S. trade framework that allowed duty-free access for selected African exports. Textiles and agriculture were the backbone. At its peak, Kenyan apparel exports exceeded $600 million annually. Tens of thousands of jobs depended on AGOA access. But AGOA expired in September 2025, and the impact was immediate. Kenyan exports that once entered the U.S. tariff-free were suddenly hit with duties as high as 28%. Manufacturers warned that over 66,000 jobs were now at risk. This is the leverage. The United States no longer needed to threaten Kenya with punishment. It simply needed to withhold future access. Kenya is not a peripheral economy. It is home to the port of Mombasa, East Africa's busiest maritime hub, a logistics gateway for Uganda, Rwanda, South Sudan, and parts of Congo, a critical partner in U.S. counterterrorism operations in the Horn of Africa. A regional diplomatic anchor. At the same time, China is Kenya's largest bilateral creditor. This dual dependence, security on one side, finance on the other, creates vulnerability. And both Washington and Beijing understand this perfectly. This is not a Kenya-only story. Kenya is simply the latest case. We have seen this pattern repeatedly across Africa. In Zambia, debt restructuring only moved forward in 2023 after China accepted IMF-aligned terms backed by the U.S. In Ghana, 2024 debt negotiations forced the government to balance Chinese obligations against conditions imposed by Western creditors. In each case, the same structure appears. China provides infrastructure and trade. Western institutions control debt relief, market access, and financial legitimacy. African governments are not choosing sides. They are being forced to rank dependencies. This is where the story deepens. The pressure Kenya faced did not come only from Washington. It came indirectly through trade eligibility, debt sustainability frameworks, investor sentiment, institutional signaling. The IMF and World Bank, while formally neutral, operate within a Western-dominated governance structure. Debt relief, credit ratings, capital flows, all intersect. This means trade decisions are no longer commercial choices alone. They are system-level geopolitical decisions. Supporters of the U.S. position argue Kenya benefits more from U.S. market access than Chinese tariff cuts. The U.S. offers higher-value export opportunities. Overdependence on China risks long-term debt distress. These points are not frivolous. China-Africa trade has historically favored raw material exports. Debt transparency has been uneven. Some infrastructure projects underperformed. But this framing hides a deeper issue. Kenya is not choosing China over the U.S. Kenya is trying to diversify, and diversification is precisely what great power rivalry now punishes. This pause signals something larger. Africa is entering a phase where economic alignment is being securitized, trade access is weaponized, and development choices are politically priced. The old non-aligned space is shrinking, not because African leaders are naive, but because the system no longer tolerates neutrality. What options does Kenya really have? In the short term, Kenya will likely delay, renegotiate, or compartmentalize the China deal. It will seek reassurance from Washington. It will hedge quietly rather than openly. In the long term, regional trade through AfCFTA becomes more important. Domestic value addition becomes less optional. Over-reliance on any single external market becomes dangerous. But these transitions take time, and time is exactly what politically constrained economies lack. Kenya did not pause the China deal because it was a bad deal. It paused because the cost of choice has risen. This is the new reality for many global South countries. Not freedom versus dependency, but dependency versus dependency. The question is no longer, who offers the best deal? It is, who can we afford to upset? And that is a very different world from the one African development strategies were built for. Kenya did not pause the China deal because it was a bad deal. It paused because the cost of choice has risen. This is the new reality for many global South countries. Not freedom versus dependency, but dependency versus dependency. The question is no longer, who offers the best deal? It is, who can we afford to upset? And that is a very different world from the one African development strategies were built for. If you found this analysis useful, subscribe to Dr. Dan's channel for clear, in-depth breakdowns of the forces shaping our world. Like the video if it helped your thinking, and share it with someone trying to understand why global trade is no longer just about economics.